Let's get our first corporate conversation going on trading our eClerx. That's the IT services company on our radar. The share price is under pressure. The company's reported a weak set of Q1 numbers. The company's top line has declined by 2% on a quarter-on-quarter basis. In constant currency terms also, the revenues have fallen 2.2%. Margins have declined by nearly 500 basis points on a sequential basis. We're now joined by the company's CFO, Mr. Srinivasan Nadadhur, to take some questions. Thank you very much, Srinivasan, for joining in. This is Reema here. While you were anticipating a revenue decline in Q1, has it been more than what you were expecting? Has the revenue fall been a little more pronounced? And what led to it? And what can you guide for Q2, Q3, Q4? You are talking about a revenue recovery in Q2.
Right. Firstly, thanks for having me on the call, Reema. So you're right. Revenue did decline 2% in USD terms and 2.2% in constant currency terms. A little sharper than what we had anticipated. And that's primarily because of weak demand that we saw both in Q4 and in Q1. A reduction in technology and onshore spend. And a decline in project renewals and some unanticipated project closures. So I think these 3 or 4 factors put together led to this decline in revenue. We are seeing the pipeline pick up. I think it's looking strong, and we do expect that we should be able to recover this revenue decline in Q2. While Q3 and Q4, I think it's hard to predict given the sort of uncertainty prevailing. I think we will have a better idea when we, maybe 2 or 3 months down the line.
But some more, color on this, Mr. Nadadhur. You seeing that pick up in the second quarter itself? Because we are, almost halfway down in Q2. So in terms of deal closures, is Q2 looking better, or will it take longer than that?
Q2 is looking better. What I meant is that Q3 and Q4 is still uncertain because, we are seeing a pickup in the latter half of Q1 and a little bit in Q2. And the full impact of all this should be seen in Q2. Because our visibility into our pipeline is at any point of time is about 3 to 6 months, predicting for significantly future periods is kind of difficult.
But Q2, so at least sequentially, you will be back to growth in the second quarter, that you're confident of?
Yes.
Okay, got that.
Okay, that's good to hear. But can you take us to what you expect for the full year? I know you said Q3, Q4 is a little bit uncertain. And you'd also, I think, mentioned earlier that maybe double-digit growth will be hard, for the full year. Is that something you still maintain?
Yeah, that, given the weak Q1 results, that I would say there is... it's going to be really, really hard to have double-digit growth because, Q1 sets the tone for what happens in the for the full year. And if we have to recover a 2% drop and try to do a double-digit growth on top of that, it's going to be really hard to do organically. It's hard to give any kind of guidance for the full year. Therefore, probably I'm not going to attempt doing so.
Srinivasan, can you talk about your margins? Your EBITDA margins guidance range is 28 to 32%. In Q1, margins have fallen sharply. Are you anticipating a sharp rebound in Q2? And do you think you will be able to achieve your full year margin guidance of 28 to 32%?
So the reason for the decline in margins is twofold. One is that we have our annual wage increments in April, effective 1st of April. And that usually results in a decline in margins in Q1, which over the course of the year, we are able to recover. And we also added people in our onshore sales and selling and distribution team. Therefore, margins went down. There was some one-off cost impact in there. So we do expect a recovery from Q2 onwards. I'm unable to comment if that recovery will be sharp. There will be a recovery for sure. If there is a revenue growth on the back of it, then we might see a better improvement in margins. So at the moment, we are sort of guiding that we will probably be at the slightly below the lower end of our 28 to 32% range.
Okay, so you won't even meet 28%. given the way things stand right now.
Seems like that, yes.
Okay, Srinivasan. Now we've discussed the numerical aspects of it. Leave us with a more qualitative idea of what's going on. What is really causing so much of weakness in the fact that you don't have visibility for H2? What are clients saying? Why the delays? What's the commentary, and what's really happening with the business?
So I think on the demand side, we are seeing there are 2 or 3 factors which are contributing to the slowness. One is the macroeconomic environment, because of which clients are sort of taking longer to decide on what services they want to buy, when they want to buy, how much they want to spend. And the other is broadly that I think that in the post-COVID period, there might have been excess spending on technology, which now sort of easing out. So these 2 factors, I think, put together once seem to result in a slowness in overall demand.
Okay, Srinivasan, we leave it at that. Thanks for joining us and, taking us through the outlook. It has clearly been a tough quarter. The revenue did decline. That is the management of eClerx telling us that sequentially Q2 will look better, but Q3, Q4 still very uncertain, and telling us that growth is likely to be in single digits for the full year and that margin will be below the lower end of their guided range as well. But with that, let's move on. And